If you've been watching any of my previous videos, you know that I'm a big dividend growth investor. I really love receiving that passive income from dividends. However, recently, I really did a critical deep dive into the performance of my various investments, and I had to be really honest to myself. I realized a lot of my dividend stocks, unfortunately, actually underperformed the S&P 500. So that's what I'm always preaching to others to invest when they start investing into the S&P 500. But actually in my own investments, quite a few of them have underperformed. And I have been thinking about this for quite a while. And I've reached another point where I understand that ultimately I need to do what's best for me as a long-term investor to grow my wealth rather than just collecting dividends, which looks nice and feels good in the moment. But actually my total wealth is not growing as fast as it could be if I invested into something else. So that's why in this video, I'll take you through my Interactive Brokers account, which is my stockbroker of choice, where I do most of my buying and selling. And I'm going to be showing you which of the stocks that I'm holding I'm going to be selling and what I'm going to be buying with that money instead. So without further ado, grab your coffee and let's get started. Right, so jumping over to GetQuinn, which is my net worth tracker of choice, where I have all my various brokers you can see over here, where I track all of the investments. But right now, obviously, I want to focus on Interactive Brokers, which has my biggest individual stock portfolio holding over there. This right here is my current performance, as you can see, which has developed actually not too bad since the beginning of the year. So overall, I'm happy with it. But if we go through position by position, you can see quite a few outliers that I'm not particularly happy with. So starting off with the Vanguard S&P 500, obviously that's the one I always recommend people to start investing in. And you can see that's actually my biggest position in the portfolio. And yeah, it's also one that is really doing very nice. Overall, I'm up $2,000 or 14%. So yeah, not crazy numbers, but solid growth over time. We know that it has been growing for the last 30 years on average, 8-9% year on year. So it's a true and tried investment vehicle, and I'm really happy with this. Now, one thing I will change, however, in the future is right now I'm buying my VUSA, the Vanguard S&P 500, which is distributing, meaning it pays me a quarterly dividend, but I buy it in Amsterdam in euros. Now that's perfectly fine if you mostly transact in euros, but now that I'm shifting to Dubai and my currency is mostly based around dirham, but more importantly dollars, and I believe in US dollars more than euro long term. Sadly, I wish it was different, but that's just my opinion. In the future, I'll be selling that particular ETF, actually by the same S&P 500, but from State Street. I recently done a video about this, which is even cheaper, only has an expense ratio 0.03%, and I'll buy it on the London Stock Exchange in US dollars. But that's for a separate video. Let's go through some of the other holdings that I have. So obviously, one of my biggest individual position is Realty Income, which pays me a monthly dividend. And yeah, right now you can see my portfolio value, but you can also see the issue with it that I'm actually down right now. So which is really not too nice. I'm down 8%. Now again, I could make a whole video about this. REITs in general have been plagued by high interest rates. High interest rates means it's difficult for those companies to acquire new real estate because it's very expensive to borrow money, right? So I think once the interest rates start falling, those stocks will do well. Overall, I do hold 3 REITs in my portfolio, real estate investment trusts, and I'm not planning to sell all of them because I do believe they really make a comeback. And in the future, I will come back to them and revisit and see if I want to hold them or not. But for the time being, I'm definitely going to hold on to Realty Income. Pfizer is another one of my bigger individual holdings, now at $4,000. And yeah, also down. See, I mean, realistically, I'm getting a very nice dividend now, close to 6%. So it really feels nice to get that passive income. But when I look at it realistically, I'm down 17% in terms of my actual money put in there. So, sometimes we only focus on the dividend, and that's great. But at the same time, we need to look at total return, and that's super important. If we jump over to Seeking Alpha, which is my favorite research tool of choice, let's jump over here on Momentum, and then I can compare it to the total performance that basically factors in the price performance and the dividend performance and gives you the total return. So both together, price and dividend, versus the S&P 500. So when I compare it over the last 10 years versus the S&P 500 in terms of total return, while the S&P went up by 245%, Pfizer only grew by 37%. So that's really bad. Obviously, the last 5 years, it's actually been dropping. Now, obviously, we know that Pfizer had a peak back in 2021. And yeah, we know what happened since then. I do believe, however, long term, they will make a comeback. So that's why right now, I'm obviously don't want to be selling at a loss. I do believe they would come back. But as soon as they will come back, I would probably also exit the position because, yeah, again, long term, it's going to be hard to invest into a single position versus if I invest in the S&P 500, they anyways would be part of it. If you buy S&P 500 ETF or any of those ETFs, you would buy also Pfizer. You see here, 55th biggest company in the US is Pfizer by market cap, and basically you would own them also in your portfolio, right? So why would I individually take the risk? As you can see, so far it hasn't been paying off. Now, don't get me wrong, I like getting the dividend. If I go down over here, you will see for the whole year, of 2024, Pfizer will pay me $160 in dividends. So it's nice, but don't forget, in most countries, you would still have to pay also income tax on that, right? So there's a lot of different aspects. The yield has been very nice, even now 6.3%. But again, right now I'm holding. I'm not planning to sell anything in minus because once again, I think once the economy turns and market conditions will turn and eventually Pfizer will make a comeback, then I will revisit it. But right now, I only want to be selling stocks that are actually in the plus, where I lost a little bit of conviction. For example, another one is BlackRock, which is a very nice company. Obviously, a lot of people invest into ETFs through BlackRock by iShares and other ones. And here I'm up, so it's great. But when I compare BlackRock to the S&P 500, to be honest, in the end, in total returns, it's pretty much the same as the S&P 500 for the last 10 years. Now, for the last 5 years, also pretty much similar. So again, you take a risk of an individual holding versus investing into a diversified ETF. And of course, once again, BlackRock is also part of the S&P 500 index. So even if you invest into S&P 500, you would also buy some BlackRock. Alphabet or Google is another one that I'm slightly up, and actually they haven't been paying me any dividends. So in the past, I was always hesitant to keep them in the first place. I bought them early on when I wasn't really chasing dividend payments. They don't pay a dividend, so I was always quite keen to sell them. And luckily, I'm now back in a slight plus, not much, but still up a little bit. So I would consider actually really selling them and instead shift some of the money that I have in my tech stocks, mostly Alphabet, Microsoft, and Apple, and shift that money into the NASDAQ 100. So here we talk about the 100 biggest companies in the NASDAQ, which are mostly tech companies. That way, I mostly invest into tech, and tech over the last few years has actually outperformed the S&P 500. So that could be something interesting. Once again, rather than particularly focusing into one company, focus on a tech ETF. So that's something I'm planning to do there as well. Vici is another one of my REITs that I'm holding, and you can see right now, similar story. Down a little bit, not as much as Realty Income, but still $100 in the minus. So right now, I'm not planning to sell, and they do pay me a nice dividend as well. So I believe long term, I like real estate, and I can see those companies definitely make a comeback. So this one, I will for sure be holding on. Altria is a smoking company. And again, a lot of people gave me a hard time when I bought it. They said nobody's smoking anymore. They're going out of business. But yeah, overall, actually not too bad. When you look at it, I'm pretty much break even. So to be honest, I could really now either take the nice dividend because Altria does pay a very nice dividend. When you can see over here, Altria pays me right now $119, almost $120 a year or 9.5% dividend yield. So very attractive. But yeah, mostly the price in recent times have been going down. So let's look at the total returns versus S&P 500. And you can see here, S&P returned 245% and Altria only 100%, so less than half. So in that way, once again, of course, you ask yourself, will they make a huge comeback in the future because of some new innovation? Well, probably in terms of smoking, unlikely. But I also can't see how smoking is going to magically make a comeback overnight. So yeah, I would be a little bit reluctant to invest much more into that company as well. Then we have another very popular one that a lot of dividend investors like. That's Pepsi. And you can see here my value right now. And I'm up $32 or 1.8%. So again, I call it break even more or less. But yeah, the question is, how is Pepsi performing versus the S&P 500? So if I pull it up over here, once again, we get a similar picture. Unfortunately, it underperformed the S&P 500. You can see 245% versus 171%. And that's including dividends, right? And yeah, if I go to 5 years, same story. You can see here almost 50% more growth of the S&P versus Pepsi itself. So, that's the risk when you invest into one company. Of course, sometimes you have companies that also outperform the S&P 500, but in many cases, you might be better off really investing into it. And once again, let's look into the companies that are inside the S&P 500. And boom, what do we see? On position 29, PepsiCo with a weighting of 0.45%. Of course, it's much smaller than some of the top 10 companies. You see here the biggest one, Microsoft, with 7.19%. But still, you're going to be owning all these other companies. And guess what? Who's shortly followed by Pepsi? Of course, Coca-Cola. And same when I go down to Coca-Cola over here. I mean, I'm also still pretty much break even, 5% plus, but very small amount, $67 up. But yeah, same story when I compare Coca-Cola to the S&P. Let's pull it up over here, Coca-Cola, and then go to momentum. We see that over here. 1 second. And here we have the total returns. I mean, once again, absolutely being demolished by the S&P 500. 245%. Obviously, that doesn't change. It's still the same for 10 years. But Coca-Cola, only 111. So less than 0.5%. So while it's nice to get a dividend income, in the end, if your total returns are still way less, so ultimately you have to ask yourself, do you only want passive income or do you want your overall net worth to grow? So Coca-Cola is definitely a company I'll be looking to sell. Unfortunately, I love being a shareholder. When I go to Costa Coffee, I feel like I'm a shareholder and owner because I am. Costa was acquired by Coca-Cola, so it's amazing. But it just doesn't make sense anymore for me to hold it because, yeah, overall performance is just not there. And now I'm still kind of break even. I wouldn't be selling them if I was in a minus, but right now I'm still doing quite well on there. Agree Realty is another company that I'm pretty much still also break even, minus $107. But at the same time, as I said, in terms of real estate investment trust, I still believe them coming back. So I'm very sure I will see green numbers very soon here, as soon as the overall interest rates will be dropping. So that's why I'm still holding on to them. Then I skipped another one, which is the Blackstone Group, another big asset manager. I'm up actually really nicely, almost 50%. So that was a really good investment for me, to be honest. And I might just materialize those profits. Because yeah, when I pull up Blackstone over here, you can see the momentum. When I see the total returns over the last 10 years, it actually really outperformed very strongly the S&P, 631% versus 245%. Now, again, you might say, amazing, that's great, it will continue like that. Or it might also have reached a stage where it might be a little bit of a reset coming in, which I could potentially foresee that it will slow down a little bit. So right now, I'm still excited to have it, but I actually might just take the profit and once again reinvest into the S&P. And Blackstone right now is also part of the S&P, right now in position 101. So again, if you invest in the S&P, you would also be owning indirectly some Blackstone shares. Now, Apple, I mentioned before, I bought it a while ago, but honestly, they've been down quite a bit in recent times. So I'm still kind of break even. I bought them quite early on. So even with the recent dip in price, there has been some adjustments. I do believe they will come back as soon as summer comes and they will launch their new AI initiatives and new products. Usually the price goes up quite a bit depending on how it goes, obviously, but hopefully it should be. But that's a question now also. Maybe I will exit my individual position and, as I said, take this money and invest it into the NASDAQ 100 ETF and therefore benefit from overall tech growth. Not specifically choosing which company to invest in, but have an overall bet on tech doing well in the future, which most likely I'll be doing with that as well. Then we have a defense company, Lockheed Martin, which, some people may or may not feel comfortable investing in. At the time, I said I'm okay with it because they do pay me a nice dividend. But yeah, looking at it, again, break even, no major price movements over here. And it's not a company I'm super excited or want to invest in more in the future. So I'll be selling out of the position as well. AbbVie, my second pharma company, basically, also rather small position. I'm up, 10%. So percentage sounds great, but as a number, actually not too much, $25. And again, it's a company, a kind of a stable company. They are paying right now a nice dividend yield of 3.65%. And the total returns have actually done really nice compared to the S&P 500. You can see here, almost double the performance. So that's a nice stock. But again, I don't know everything about the company. It's really hard sometimes to stay on top of it. For pharma companies especially, it comes to the different patents that they have, the product pipeline, and sometimes they work many, many years on one new product and then they have to cancel the whole project and they will lose a lot of revenue. So, sometimes if you're not really in the matter, it's hard to actually follow. And honestly, I'm a one-person show. I'm building all my business myself. I'm investing also myself. So sometimes I don't have all that time to really do that research. And once again, that way, if I invest in the S&P 500, I would still own some AbbVie. They are the 22nd biggest company right now as per market weighting in the S&P. So you still have best of both worlds, right? And lastly, we have Thermo Fisher. They basically do the raw ingredients for pharma companies and have been doing so very successfully. I'm up 10% once again. However, as a dividend investor, while the yield is very little at only 0.27%, actually the growth has been staggering. A 5-year annual compound growth of 15.52%. Basically year after year after year, it's been growing like that. And the payout ratio is still very little. So they can really continue to grow that even further in the future. And when you compare it to the S&P 500, once again, over the last 10 years, they've also really nicely outperformed it. So it's a solid stock, but not something I would be actively investing in as a dividend investor because, at such a low dividend yield, it doesn't really add much to my dividend income. And that way, actually, I earn more from the S&P 500 because they pay me around 1.4% right now. Thermo Fisher will pay me significantly less. And once again, if I look for Thermo Fisher in the S&P 500, right now is the 32nd biggest company in there. So once again, I would be benefiting from the strong performance being an S&P 500 shareholder. But talk is cheap. I'm all about action. So let's go over to my interactive brokers portfolio. You can see it over here. And let's sell those shares that I want to sell and obviously buy with the money the new one that I want to buy instead. So let's go over the portfolio over here. And then you can see here the various stocks that we discussed. Now, first one, obviously, Wusa. For the time being, I'm leaving. As I discussed, I will do that later on. But overall, I'm still benefiting from the gains in the S&P 500 here. Just that I want in the future a lower expense ratio. And of course, convert my euro holding into US dollar holding. Then my realty income, I'm going to leave it, as I said, until interest rates will recover. Pfizer, on the other hand, as I'm down quite significantly right now, I don't want to materialize that loss because actually I haven't lost money. It's just the paper loss. I will only materialize it if I sell it right now. But as I believe, even if I have to wait 1 or 2 years, eventually I will be in the green and then I might decide to sell it and switch it into something else. But for the time being, I'm going to leave it over here. Now, BlackRock, on the other hand, as I mentioned, I'm up in the plus. And honestly, I'm just going to go ahead and take the profits here and sell out of the position. So let's click into this. Then I'm going to navigate to sell over here. Or the easiest and fastest way, if you go over here where it says your position, click the 3 dots and then click on close. It will pull up all the quantity of shares that you have. You can see 3.826 shares that I have right now. Then if I want to go ahead, I click on preview to see any commissions there is. I would be paying 36 cents, which is really not too bad. And then if I'm fine with it, click on submit sell order. And boom, it will take a second and it will be sold. Now, to be fair, right now the markets in the US are still closed. So unfortunately it won't go through, but as soon as they open, that sell order will be triggered at the market price, obviously. So it might be a little bit up or down depending at what price the market will open. But as soon as they open, it will be executed because it's a very liquid stock. And then I will have the funds in my account, which I can then use to reinvest into another share. Click on done and boom, that position will be closed. Trade, orders and trades. I can go over here. And then I can see, there's a sell order on BlackRock. And yeah, basically it's been submitted. And as soon as it will open, I think it's now in 2 hours or something, it will be triggered and it will sell my shares and I'll have the cash instead. All right, continuing on. Right now, I still have some other ones over here. So for the time being, I will also be selling out of my Pepsi. So let's click into Pepsi over here and then go over to the 3 dots once again, close. And then I see all the shares that I have. I'm happy to sell. Click on preview. Yep, see once again the commission level, 40 cents, perfectly fine with me. Submit sell order, and boom, it will once again, as soon as the market is triggered, obviously it's based in the US. Once they open, it will get sold and I'll have the cash instead. Going back into my portfolio, let's continue the list down here. The same I want to do with Coca-Cola, so let's click into Coca-Cola, go ahead and close the position, close, preview. Yeah, I can see over here what it is. Obviously, this always makes you a little bit nervous. Coca-Cola is flagged for animal testing. So in a way, it's sometimes good that they flagged it, but sometimes then you get really nervous if you want to invest something. You have to do some research. Yep, I'm good with this. Click submit sell order. Once again, similar principle. As soon as they open in the US, that sell order will be triggered. Let's go back into the portfolio. I also want to be selling out of my Lockheed Martin position because it's fairly small. And as I said, I wouldn't want to be investing anything more into it. So let's close that position as well. Click on preview. Once again, all my shares are going to be sold. Yep, fine with this. Go ahead and done. Once again, back to the portfolio. I will also be selling my AbbVie position. As you can see, I'm selling only all those positions where I'm in the plus or at least break even because I don't want to be materializing any losses at this stage. Because most of the stocks, I still believe in them long term. I just wouldn't be too bullish on them. Some of them, as soon as they hit break even, I might just exit the position and then once again shift my funds into something else. So close it over here as well. Preview, see what it is. Yep, 36 cents. Good with that. And go ahead. And also my Thermo Fisher position, which I've shown you before, which has been doing quite well actually, but in terms of dividends, doesn't really add much to my portfolio. So that's why it doesn't really make any difference to my dividend income. So obviously my dividend income overall will be going down after selling some nice high yielding dividend stocks, but at the same time, my overall portfolio returns will actually increase. I think that's a smarter choice there. Yep, go ahead, sell the order. Done. And also Blackstone actually decided to take the profit. I'm up quite a bit and I'm not sure they will be able to continue this momentum of outperforming the S&P by that much. So that's why I also want to close the position over here. I made some good money from it and I'm happy with that. And then I can reinvest the profits elsewhere. So let's go ahead and exit out of the position as well. Very low commissions, done. And once again, that will be triggered once the markets open. As well as Morgan Stanley, I will also be getting rid of them. Obviously, I'm up nicely by 10%. So I'm happy to take that profit and reallocate to other investments. So let's close out of this as well. And here we go. Once again, same principle. So very straightforward. You see, once you get the hang of interactive brokers, it's just so easy to use and navigate. So that's what I like about it. Okay, and there we have it. So if I want to confirm, I just go once again into orders and trades, and I'll see here all the pending trades that will be done as soon as the markets open. They will all be triggered, and then the money will be paid into my account, and then I can make the new purchase. Now, obviously right now, I don't have all the money, so I can't do all the big purchases, but I still have some money in my account. So I will show you what I'm actually going to be buying with it. And as soon as I have all that money, I will also use it to deploy buying more of that particular ETF. And what I'm talking about is the S&P 500, but not from Vanguard, but from State Street. That's the ETF I'm going to be buying because that's right now the cheapest S&P 500 ETF you can buy if you're not living in the US. It has an expense ratio of 0.03%. It is distributing and obviously full replication. The fund size is quite big, which is good. I'm happy with that. And then if you go down over here, you can see the stock exchanges where you can buy it. So you can see from all these various lists where you're going to buy it from. But in my case, obviously I want to buy it in dollars. So there aren't too many options. I could either buy it in Switzerland or in London. But again, I have quite good experience with London. That's why I want to buy it on the London Stock Exchange. That's the ticker symbol. And yeah, all I have to do now, go back to interactive brokers, head over here, put the initials over there, SPY5, then select it. That can be a little bit confusing for some in the beginning where to actually buy it. But in this case, this initials basically means London. So click into this and then obviously stock. Yeah, double check. It will pull it up over here. So you can see already the currency is USD. That's fine. I can see even by that initial, it is based in the UK. It's operating. That's good to go. yeah, I'm happy with this. Let's go ahead and buy something. And one thing to keep in mind with ETFs, sometimes it's actually better to buy a whole share rather than a fractional. I want to go ahead. Usually I buy for $500, but since one share is pretty much similar to the amount that I would normally buy it for, I can just leave it at one share. It's a little bit more than I would normally spend, but hey, then I have a whole share of that particular ETF. So let's click on preview over here. Then I can see the commission. Yes, the commission is a bit higher than you would have on US stocks. That's something to keep in mind. $1.70 for $500, that's around 0.34%. So less than 0.5%, which for me, honestly, is really not too bad. And it's with a trusted broker on a trusted exchange. So I'm happy with this. Obviously, the more I bought, it would still pretty much be a similar amount. So $1,000, if I would buy once a month for $2,000, my commission would be less. I would still buy it for around $1.70. So in that way, it makes sense to buy it once a month and save a bit of commission. But I like to dollar cost average, so every week, and therefore potentially get a better price. So that's why I'm okay with this. And yeah, let's click on preview. If I'm happy with this, all I have to do now, go ahead, submit buy order, and boom, it has been filled because obviously London Stock Exchange is open right now. I'm now the proud owner of one full share of the S&P 500 ETF through State Street. All the companies that I just sold, plus all these other 500 beautiful companies in the S&P 500. And yeah, honestly, without doing a finger, I'll be benefiting from the performance of all of them. So even if some of them are doing poorly, some others are doing great, and overall, obviously lifting my S&P 500 performance up, and therefore I'll be benefiting as a shareholder. Right, so click on done. And then if I go back into trade, you can see here that trade has already been fulfilled because obviously I bought it right away. So you can see it bought, done, and filled. So that's good. If I now go back into my portfolio, you see here the new addition usually indicated with a blue dot, meaning that new additions have been made. Well, there you have it. Obviously, quite some drastic changes to my portfolio and investing strategy. And yeah, it might come as a surprise to many of you who like dividends as much as I like. I still like dividends, don't get me wrong. I think some companies are really amazing companies, but ultimately I have to look at the total performance. And you saw a lot of the companies that I compare to the S&P 500, they just underperform. And obviously, past performance is not a guarantee for future results. Maybe some of those will do amazingly well and outperform. But honestly, when I think about it, will Coca-Cola really do much better in the next 10 years than they have done in the last 10 years? Probably not, right? I mean, unless they come up with some crazy innovation, I see more future and potential growth in tech, AI, and all these things, rather than some consumer staples that people need on a daily basis. They will always do well. That's why they will continue to pay a dividend. But the overall growth and returns, I don't see them at least outperforming the S&P. They might do quite okay, but definitely not outperform that. That's why I think ultimately I need to look at the total returns, because technically in the end I could pay myself a dividend, right? I could every year sell a little bit of my portfolio in the form of passive income when I get older and live from that, right? While it's nice psychologically as an investor to see your dividends growing, and they have been really nicely developing over the years, ultimately if your overall returns are slower than the S&P or some other market benchmark that you compare yourself to, then technically as an investor, you're not really maximizing your money. Obviously, I keep you updated how it goes with my portfolio, but I think for me in the long term, probably a smarter way to go about it, because I don't have a crystal ball which stock is going to do the best. And a lot of people ask me, which company should I buy? And you always see the hot stock of the month. People invested so much money into Tesla. Now Tesla stock went down. They got all depressed, sold at a loss, and move on to the next stock. So again, I don't want to be stock chasing. I don't think it's good long term. I don't want to spend all my mental capacity looking and researching them, because ultimately we always anyways behind what the insiders know. So we always one step behind. So I rather focus on earning more money and then taking that money and investing it into something safe where I know it has a proven track record of growing my wealth over time. What do you think about it? What are you going to do with it? You're still going to hold on to all your dividend growth stocks? You're going to sell some of them? Always happy to hear from you, and I'll get back to every single one of you. Only very few people managed to actually get until the end of the videos. So if you did, I really appreciate you. And as always, stay healthy, get wealthy, and I see you in the next one. Ciao.